Hello everyone. So today we are going to discuss about the types of inflation that prevails in an economy. So there are many kinds of inflation that happens on a certain time in an economy. So we'll start with demand pull inflation. As the name suggests that this inflation is because of the increased demand in an economy. Increase in demand can be because of reasons like increase in disposable income, increase in money supply in an economy, where the economy is going in an expansionary phase. So it will lead to increase in demand, but the supply will remain same. So we can say that there are many buyers for the same product. For one product, there can be many buyers. So when there are many buyers for the same product, the demand will increase, which will lead to increase in inflation as the producer will try to maximize its earning. It happens during economic growth when the economy is growing steadily and rising at a good rate. Like for example, in India, since the India is the fastest growing economy in the world, we can say that there is a demand for inflation that exists in the economy. Cost push inflation, as the name suggests, it is pushed by the cost, which is like increase in raw material cost. Like for example, if there is a crude price, crude oil price increase in the economy, so the price of diesel and petrol will go up. So as we understand that diesel uh, is something that is involved in production of most of the material because it helps in transportation. So the price of transportation will go up, which will leads to increase in the price of the products. Built-in inflation mostly happens because of the wage increases. So wage increases as the worker demands high prices, which is also known as wage push inflation. So as the labor will get costlier, the producer will try to uh, balance the increase in wage cost by increasing the prices. Hyperinflation, as the name suggests, it's like hyper as in inflation is at an exponential level, growing by around 50% a month. It happens when there is a currency devaluation, where there is a rapid decrease in currency value or economic instability, whereas its most important cause is printing the currency in their own country. For example, Zimbabwe started printing their own currency, which leads to higher increase in money supply, and the supply of the products didn't increase. So demand for the same increased many a time. So it leads to around 1,000% times increase in inflation in Zimbabwe. Then the same happens in Venezuela also. So this is known as hyperinflation, and the inflation is increasing at a rate of 50%, 60%, 100% a month, which goes up to 1,000%, where the currency value becomes negligible. Like if the Zimbabwe started printing the notes for one CR, so that's known as hyperinflation. Stagflation is not a normal kind of inflation. Stagflation basically tells us that if there is a increase in inflation, there will be increase in unemployment as well, which normally doesn't happen in a normal economy. Because in the normal economy, what happens is, okay, if there is an increase in inflation, there will be a decrease in unemployment, because increase in inflation leads to increase in supply. So the producers will increase their supply, which will leads to increase in jobs, and which leads to reduce in unemployment. Uh, in the normal scenario, it is also explained by the Phillips curve. Phillips curve tells us that is a relation between high inflation and uh, is a relation between inflation and unemployment, and which says that if there is a high inflation that prevails in the economy at a time, then the unemployment will be less. But the failure of Phillips curve is known as stagflation, which is also known as stagnant growth, and there is no growth. Deflation and disinflation. So what deflation is general price decreases, in which the mostly inflation goes negative or below zero. So that means the price decrease, and there is not inflation in the economy, so products become cheaper. Whereas in disinflation, what happens is the inflation reduced from the previous year prices, but it is still positive. So if the previous year price was 6% and this year price is 4%, so we'll say that there is a disinflation in the economy by 2%. But it is different from deflation, in the case that deflation is a negative inflation, in which the prices are cheaper, whereas the deflation is according to the previous year prices. Creeping, as the name suggests, it's creeping. It's like moving very slowly. So if there is inflation in the range of 3 to 5%, like it's an annual inflation, as India has a monetary policy committee in India has suggested 4 plus minus 2 percent of inflation in the economy, so which is known as creeping inflation, which is good for an economy because a little bit of inflation is good for economic growth. And the prices increases slowly over time. It also signifies good economic stability and economic growth. So creeping inflation is good for an economy. Galloping inflation is the inflation where the inflation is in double digits. So it could be anywhere between 10 to 99%, uh, which is dangerous for an economy. It can lead to hyperinflation in the longer term. It could destabilize the economy. It happens because of currency devaluation or something, some economic instability where the supply side get a major shock and there is a high demand because of the increased in money supply. But it has not reached a point where it will be called as a hyperinflation. So a double digit inflation rise in inflation is known as the galloping inflation. Thank you so much, guys. I'll see you all in my next video. Thank you so much.